Welcome to this Friday edition of Inside India. I'm Sri Jegarajah. Your headlines. The chairman of the Securities and Exchange Board of India talks to CNBC about attracting foreign investors to the Indian market, secondary listings and where things stand with a potential NSE IPO.
There are certain issues which are being discussed and flagged, and in my belief is that they're going to be resolved soon.
The Indian rupee pulling back from a one-month low as the US dollar and yields ease, which could support market sentiment today. Indian Prime Minister Narendra Modi doubles down, refusing Pakistan access to water controlled by India amid their ongoing standoff. Welcome to the programme. Let's get a read on the Indian markets just ahead of the open in about 45 minutes. Let's give you GIFT Nifty equity futures are giving us an opening number in the region of 24,681. So we are looking at a very modest lift of just under 100 points at the open for the benchmark Nifty. And let's take a look at the dollar-rupee exchange rate. 85.9770 is where we are standing. To our top story of the day, our exclusive interview with the chairman of SEBI, Tuhin Kantapande. He took over the reins of the Securities and Exchange Board of India, which is the country's market regulator, back in March. And we asked him about the long-pending IPO of the National Stock Exchange of India and the and the rise of retail investors in the country. Take a listen.
I think the domestic retail investors are really maturing. We have now 13 crores unique investors, and they've been able to provide a lot of resilience. And many of them have really learned, that it is better to stay long, it's better to stay invested, and not to get panicky over the market downturns, which are inevitable. Corrections are inevitable in a market.
Do you feel that the Indian markets are heading into a more volatile environment, given the balance of external risks and given the domestic story in India?
I think the volatility has to do with many of the global events that have taken place of late on the trade side. But then I think these are also fairly under the, I would say, it's a new normal, basically. I think the volatility is a new normal and the markets have learned to live with it. But then volatility in India is not exceptionally higher than the rest of the world. Thank
you for that, sir. Let's move on to the rules for SME IPOs, and SEBI has been tightening the rule book in that area. But it's a balancing act, isn't it? How have investors, pre-IPO, SMEs and the broader market responded to your actions?
I think it's also a kind of looking at data and learning. And while SME IPOs have facilitated the entry of some of the SMEs, we have a very large number of SMEs. So given that SME IPO is a very small fraction of SMEs that we have, access to capital market is being provided through exchanges, and we have, of course, responded to some of the situations and slightly tightened the system of clearances and entry norms.
Let's bring in the NSE angle if we can, Mr. Pandey. Is SEBI fundamentally opposed to an NSE listing?
Not at all.
What needs to change within the NSE for SEBI to approve a listing?
I think there are certain issues which are being discussed and flagged, and in my belief is that they're going to be resolved soon.
In your discussions with the NSE, are you getting any clarity then on whether leadership there is making the necessary changes that you have suggested? And just walk us through what needs to change, whether it's on the litigation side, I know that there are issues with the clearinghouse that you have flagged, which we will get on to later. But can you be a bit more specific, sir, on what needs to change at NSE to facilitate a listing ultimately?
I think all of the issues will be resolved. I think that much I can say, both on the governance, litigation, technology, all of it. It's possible to resolve. I think they're quite amenable to solutions.
Above all, is there any progress on the NSE clearing operating independently, which has been among SEBI's requests? And what progress or otherwise is being made on that front?
There has it's not been a definitive direction from SEBI. It was put out as a measure of public consultations in November 2024. Is a possible way whether we could do that, but there are different models in the world, and there is no one model which we can say is the only way we can work. So there are very much possible to resolve things and still move ahead.
All right, sir. Let's talk about the rules of the road in a bit more detail about when it comes to futures and options speculation. Why did SEBI feel the need to restrict F&O trading in India at this point in time?
We aren't really restricting it. We have, I think we had an excessive retail activity on some of the products, like index options only on the expiry day. The rest of the future and options are in any case going on. And
understood.
On the index options weekly expiry day, we had an exuberant activity on the expiry day, which was creating some distortions.
So you were concerned that excessive speculation by retail investors in these parts of the derivatives markets could lead potentially to a market effect?
I mean, to that extent that, they have been losing money, and which is our study report pointed out over the last few years. So we are also cautioning.
How does SEBI justify increasing oversight while simultaneously relaxing the gross position limit? Any thoughts there, sir?
I think we had proposed in a consultation paper some of those issues which have been responded to in a wide variety of ways by different players. We have received more than 800 comments, public comments, and following which we will be able to formulate our position very soon, possibly within this month.
And what is the longer-term vision at SEBI for the derivatives market regulation, given the recent changes that have been implemented and that you plan to implement?
Derivative market is an important market for both hedging and price discovery. And so therefore, in fact, the market will also diversify further. And SEBI recently has given in-principle clearance for energy derivatives in future.
Let's turn to finfluencers. Your thoughts there, and how much of a threat do they represent to the smooth running of the marketplace and also investor confidence?
I think there is a big problem, not only in India, worldwide. We had discussed this in ISCO meetings earlier in Qatar. And the entire ISCO, we have been engaged with this process of both platform providers to check the sort of unscrupulous elements, as well as also the issue of influencers. In cases of influencers, we have registered investment advisors and research analysts, which actually have a code of conduct. But if there are influencers on social media which violate this code of conduct, we are constrained to take them down with the help of platforms. So far, we have been able to take down many such influencers. And moreover, we have also mandated as a market regulator that they would not be able to access the advertisements of the registered regulated entities unless they are registered themselves with us as registered investment advisors.
So as you see it, these finfluencers are breaking the securities law and regulations.
That's right.
What is the thinking behind and the rationale behind not allowing these finfluencers to use live pricing, instead referring to 3-month-old stock quotes? How does that help?
I think we have to take a situation in a balanced way. We have all this is available all through. The prices are available all through, and the Indian markets are very robust. So we don't need influencers to be showing live prices.
And is SEBI working on a broader investor education as we see this rise of the retail investor, especially the younger generation that could be duped or taken in? And this is a cohort, an investing cohort that is consuming more social media. How are you addressing that part of the market that is growing and that could be vulnerable?
You're right. I think this is a very important area to work on in a variety of ways. And we are SEBI and its entire ecosystem, which includes market infrastructure institutions, which is also market intermediaries, and and other parts of the SEBI ecosystem will jointly come together with a plan of a much wider thing, apart from what everyone is trying to do in a much more coordinated fashion on the various aspects of investing awareness. Is not only responsible investing, but also safe investing, particularly from safety from the cyber frauds that many investors are sort of getting duped. And we need to widen our approach. Also, we would actually seek a much more active participation of the people at large, or we'll seek their own ideas how to go about it, because some of the time
Yes.
we will find that we will get more innovative ideas how to deal with this scourge.
Let's bring in cryptocurrencies, Mr. Pandey. How is SEBI approaching the crypto ecosystem as it applies to the markets from a regulatory standpoint?
Well, in India, the policy call needs to be taken on crypto as to whether to regulate it. It's still not a security. It's taxed, though, by the income tax department at the highest rates. And India has also agreed to join the crypto reporting framework from 2027 internationally. And for that necessity, changes in the laws have been made so that, this could be, this information could be obtained. But otherwise, crypto is not yet regulated in India and not treated as a security. So it's not under SEBI's remit yet.
Now, let's talk about how SEBI is positioning the Indian markets for overseas investors and opportunities in the international markets. How is SEBI making it easier for foreign investors to invest in Indian equities?
We've actually accelerated the engagement process with the FPIs. We have an FBI outreach cell which can be reached out to an email, the specific email. And there are also web programs through video conferencing being done in order to learn our changes and modifications of procedures. And we have responded to some of the difficulties that the FPIs might be facing in terms of registration and also tracking their applications. The application processing time for registration has come down considerably, and the average time taken will be about 30 days now.
Are there any countries that are part of a blacklist, for want of a better description, that SEBI does not want to invest in India, that are barred from investing in India?
No, I think we have a framework which is there. I don't want to specifically say that, but I think the framework provides for all the details and how they have to be given. And increasingly, we are making it possible for them to actually do it online without physical documents. And we are also encouraging them to use the digital signature in India, which is easily available. They can do it online, and so that they can file their documents without physically delivering them through couriers.
Understood. And when you look at the global narrative right now, India is becoming the China offset. Can we expect, in line with that, more secondary listings via instruments like depository receipts, for example?
Let's say we have got some proposals. We are looking into it.
And how close are you? Can you give us a little bit more detail on that? How close are you to seeing that come into effect?
I think this is a preliminary proposal at this moment, so we will need to examine.
Coming up on the programme, the US House of Representatives clearing President Trump's big, beautiful bill on taxes and spending cuts. In the meantime, yields have been moving higher on deficit fears. How does that play out in emerging markets and in this part of the world? We'll discuss that next. Welcome back to Inside India. Let's take a look at US Treasury yields, particularly on the longer end, where we have seen a lot of action. The 30-year yielding 5.0426 and the benchmark at 4.53074 at the 10-year yield. Rate sensitive 2-year at 3.9879. Yields did pull back a bit, but the longer end still at elevated levels, and worries over the US fiscal position and outlook and government debt have been weighing. US House of Representatives narrowly passing President Trump's sprawling tax and spending package overnight. The bill now faces another hurdle, and that is a difficult battle in the Senate. We are keeping eyes on bond yields in emerging markets while we are at it. This is where we stand in particular for India, the 10-year bond yielding 6.218. Let's bring in Amol Shitole now, Head of Fixed Income at Mashreq Capital. Amol, great to have you on Inside India. Do you feel that this global bond market sell-off intensifies, and does it tell us that perhaps the bond vigilantes are back?
Good morning. Good to be here. Yeah, you're absolutely right. The US tax bill is massive. Bond investors don't like unfunded tax cuts. They don't like deficits. Bond supply, and this bill is likely to result in deficit increase by 1 to 2% per year for next 10 years, sorry. And that is equivalent to $300 to $500 billion of additional bond supply a year. So that's something which is already reflected in the shape of the yield curve. The 230s yield curve has steepened by 225 basis points since the lows of 2023. And I think this trend is likely to continue in the near term. Having said that, the large move is behind us in our view. We got to look forward to the U.S. growth worries at some point later this year. And I think the safe haven demand is likely to come back in that context as well. Don't forget the Fed's toolkit as well, right? I mean, Fed can relax the leverage requirements for the U.S. banks that could increase demand for the U.S. Treasuries. And in severe Treasury disruptions, we can see Fed moving from QT to QE. So we expect these higher yields are not likely to be sustainable over the medium to long term. However, the near-term pressure is likely to continue because of the noise we are seeing in the U.S.
That's interesting. I'm also, in terms of the path of least resistance, then an appropriate policy outlook for the Fed, where are you putting it, and how many more rate cuts do you expect in the current cycle?
That's a very interesting question, considering the inflation expectations in the near term are a little elevated. But then if you look at the five-year forward inflation numbers, they're quite measured. We still are expecting 2 to 2.5% kind of inflation over a 5-year period, though the 1-year inflation number looks like 3%. Having said that, investors are looking for increased Trump premium, and if you put it all together, I still think 2 rate cuts this year and 2 next years are plausible. That should take Fed fund rates closer to 3.5% from 4.5% in our view, and that would also mean the 10-year yield should be more towards 4% level or slightly below than 5% levels, which market is anticipating at this point in time.
Right. So, Amol, or do you feel that the entire tariffs as taxes and higher inflation narrative has been laid to rest because we now have détente between US and China, or is that yet another risk that could reignite the bond markets?
Well, it's a great and relevant question. See, I think that most of the risks are well known now, right? With respect to tariffs, market is kind of coming to the conclusion that the tariffs are going to be settled closer to 10 to 15% level instead of the astronomical number they were talking about at the beginning of April, right? So I think the most of the news is known. Most of the facts on tariffs are known. And I think yield curve and the US Treasury markets are factoring that all in. With all the negative developments for the US Treasury market, be it the downgrade, the weaker auction, the tariffs, the consumer expectations of the higher inflation numbers, we are still seeing 10-year comfortable at 450 to 460. I think that's quite measured. And I think what bond market is telling us that they're looking forward for next 2, 3, 5 years and discounting the lower inflation that will come eventually in the market. So I think the near term, the noise is quite high. But then if you look at the fundamental signals or the medium to longer term, I think Treasury market is reacting quite nicely here at 450, 460 at the 10-year.
Interesting. Amol, so what kind of spillover risk potentially is there from a relatively high yields environment? Or if you feel that the worst is behind us, then do we have to worry out in emerging market land and with particular reference to India?
Well, I mean, EM markets are correlated to US markets. You can't really diversify all your risks away. Having said that, if you look at the EM hard currency debt markets, including Middle East, that's our local market, markets have been quite resilient to the US noise. YTD returns on EM and local bond markets are close to 2.5%. And I think the fundamentals are quite strong. You're still getting quite handsome yield pickup if you move to EM for the rest of the year. However, on the spread side, you got to appreciate that the spreads are quite tight. The Bloomberg EM aggregate bond index is trading at yields of close to 220 basis points. That is 100 basis points tighter than the 5-year average. So if US Treasury is continue to stay volatile and move towards higher end of the range, I think there's room for credit spreads to widen out from here. And that could impact the high yield credit issuers more significantly than IG. So we expect the cost of borrowing definitely could go for the EM issues for the rest of the year. And you got to be absolutely selective and diversified with our security selection and asset allocation. So I think EM is vulnerable for sure. With respect to India, it's more a local currency debt market than the dollar bond market at the sovereign level. Having said that, if you look at the India as a story in itself, it's one of the improving stories within Asia. It's one of the least impacted economies from tariff within Asia compared to China, Japan, or other counterparts. And bond investors like lower inflation, they like higher yields, and we're getting combination of both of that in India. So we don't expect the underperformance in Indian local currency bond market in that regard. So I think that market is likely to stay resilient. We should expect 30 to 50 basis point compression in yields. That would mean capital appreciation potential on top of the carry you're getting there. So it's something which we find attractive within Asia at this point in time.
That's interesting, Amal. And given that the global markets are fixated on the fiscal position, India and the fiscal consolidation narrative, do you believe that that is intact? And also, when you look at the leading indicators, when you look at inflation, there appears to be a sense that inflation genie is maybe back in the bottle. Outlook seems to be quite well anchored when it comes to price pressures. What are the implications then when you tie it all together for the RBI and for the Indian yield curve?
Well, as I said, all good news, right? I mean, you have lower inflation, we have higher yields. The central banks are very prudent. They have been quite I'll say major in terms of their fiscal response back in COVID as well. They were not as loose as DM or some of the other central banks within EM. So I think that is something which is going to benefit Indian bonds. I think RBI has a little more room to ease if required because of the inflation narrative, as you talked about. Lower oil price does help India, right? It's an oil importer. And then if you look at the Brent oil prices, they're about $65 per barrel. We expect that to be at the lower end of 60 to 70 range this year. That is likely to support the oil importing economies, especially in Asia, and India is one of that. So I think it's an interesting bond story in local currency space in Asia for sure.
Amal, we'll leave it there, sir. Thank you very much indeed for joining me on Inside India. Amal Shithole there from Mashreq Capital. Coming up on the programme, we will talk tariffs and markets from a G7 ministers meeting to Apple increasing its capacity in India. Stay tuned. Welcome back. Let's take a look at the Asian markets. But before we do so, there's some lines coming through from the Japanese Prime Minister in terms of the discussions that he's been having with his US counterpart, President Trump, and the team there in the White House. No change to our stance on US tariffs, Prime Minister Ishiba says. No change to our stance of demanding an elimination of tariffs, and no change to our policy of talking with the United States on creating US jobs. There might be an occasion where I will visit, Prime Minister Ishiba says, the United States for in-person talks with President Trump, and they discuss diplomacy and security. And this is after a phone call with US President Trump and Prime Minister Ishiba of Japan. That lasted for about 45 minutes, according to GG News. In the meantime, the finance ministers and central bank governors of G7 countries met in Canada, showcasing their unity in face of, quote, multiple complex global challenges. G7 did not actively mention US tariffs, but vowed to address excessive imbalances in the global economy. The group also warned against more sanctions on Russia. Staying with tariffs affecting companies across the world, Emily Tan spoke to the CFO of Lenovo in the last hour about that and joins us from Hong Kong with the details. Good morning, Emily.
Hi there, Sri. And Lenovo, the world's #1 PC maker, of course, being the big export giant that it is, of course, getting impacted by Trump's tariffs as the company operates in 180 different markets. It has manufacturing facilities across 30 countries. So it is basically very well diversified, but it can't shy away or can't hide from the Trump tariffs. And that really showed through in the company's earnings. Full year profits up 37% to a record high $1.38 billion. Robust sales growth, and they attribute that to their hybrid AI strategy and the numbers being the best in the company's history. Revenues of $69 billion. But what the market was paying attention to was what happened in the fourth quarter. The earnings, the profits coming in well short of expectations, but that they explained was due to a cash decline in the value of warrants. That's related to the strategic partnership with Alat. Profit down 64% to $90 million. Revenues of $16.9 billion. So this impact from the warrants is going to be lingering for the next 3 years, and that was what Winston Cheng he pointed out to me when we were having our wide-ranging discussion. We were talking about the tariff impact. Let's listen in on what he had to say.
Have you seen the Chinese and the U.S. government come together? And I think there's been positive news coming out of that. We're hopeful. I think the markets have reacted as such, and it seems like the regulators are also looking at what's happening in the markets. And I think markets clearly have voted against the high tariffs. And then when there was reprieve, I think they have come back, certainly in the U.S. market side, right? So I think overall, hopefully the regulators can come together to an agreement. And I think the market should have a clarity. The operators like us have clarity as to what that level would be, if any. And then we can then therefore build our plans and plan our business accordingly.
The company says that Trump tariffs dented their March quarter results. It had a significant impact on their performance last quarter, and they described the hit as a pretty big number, or not a small one, and that prevented an even stronger growth in their earnings. They've built up multiple manufacturing facilities across a number of countries, and they are not worried about tariffs, they said, but they are worried about the uncertainties and the quick changes. China continues to be, of course, their main manufacturing site. They say that China retains an edge with efficient, low-cost supply chain that no other country can replace. So, of course, they are heavily exposed in China, but they're also building out in India as well. Sri, as we know, of course, they're not the only big tech company that is building out in India, as we hear from other companies like Apple and Hanhai Precision, of course, building up their manufacturing in the Indian market as well. Back to you.
It has been stop-start, but supply chain resiliency is the name of the game at the moment. Emily, thank you very much indeed for that. Now, in the meantime, US tech giant Apple is planning to expand its footprint in India. We covered its contract manufacturer Foxconn's fresh $1.5 billion investment into India. The Financial Times reporting more details on it. The new investment is reportedly for Foxconn's component plant near Chennai in Tamil Nadu, helping expand its supply chain in India. It would be building a display module facility facility majorly to supply Apple, Foxconn's biggest customer. This comes as President Trump told Apple CEO Tim Cook that he is not happy with the tech giant building in India. Let's bring it back to the market open in India. We're about 10 minutes away. Let's give you the futures picture once again. GIFT Nifty futures giving us an opening number in the region of 24,700. So that would portend about 100 points to the good. Dollar rupee exchange rate 85.98. Well, just flipped over to 86.02. Let's bring in Praveen Jagwani now, CEO of UTI International. Praveen joins us from Dubai. And welcome to the programme once again, Praveen. Great to have you. In terms of the outlook, are there enough positive drivers to get the Nifty 50 back over 26,000?
Thanks, Sri. Great to be back on the program. In the medium to long term, absolutely. The key drivers for India's economic expansion are in place. And I think this is the key message, that India is quite distinct from what's going on in the rest of the world, which is inflationary pressures led by deglobalization. India, on the other hand, because it produces all its own food, is not experiencing any inflation. Inflation came in at 3.2 last month, and overnight rates are at 6%. The Central Bank of India has cut rates twice. There's a positive real interest rate of about 2.8%, which clears a runway for the RBI to have at least 2 more rate cuts this year, which is a massive boost for the economy, which is mostly consumption-led. And that creates the platform for greater earnings and for Nifty to continue its long-term rise.
So, with that, Praveen, and it's a constructive backdrop, isn't it? Retail, institutional investors, both domestic and foreign, where are flows going? And from a sector point of view, where and how are they positioning in this market?
So the big story really for domestic investors is consumption. India's middle class continues to expand. I mean, everyone knows this. It's the boring old story of more people coming into the middle class with rising disposable incomes and buying everything: tea, coffee, soap, shampoo, fast fashion, and pizzas, if you will. So domestic flows continue into consumption. However, global investors are still sitting on the fence, because the big part of any global portfolio is US stocks. And when that is giving you a great deal of worry and uncertainty, you don't really focus on the satellite positions in emerging markets. So as a consequence, global flows still very patchy, while domestic flows continue to be robust in consumption-led areas.
So what could go wrong with the current setup? And to your point on how global investors especially are positioning towards the Indian market, what grey swan risks, Praveen, are you watching? Could it be a flare-up of the India-Pakistan conflict? Could it be the global bond market sell-off, a collapse in the US-China trade detente? What could go wrong with this broadly positive consensus that we have right now?
Sri, you hit the nail on the head. It's really those two things. Historically, a big worry for India has been the price of oil. But given the moves of OPEC and where global growth is headed, oil prices don't seem to be the main worry for India or India's growth story as of this point. It is really geopolitics, and what's unfolding in the subcontinent is realistically a proxy war between US and China for managing security of energy and security of trade routes. And then that will play out in multiple theaters across the world in the years to come, because this is really a struggle for supremacy as a global hegemon between China and US. That will have untold impacts,
yes,
and the ramifications of which I don't think we fully appreciate as of this moment.
It's a great point, Praveen, and it is something of a sad state of affairs globally when the biggest winners are the military-industrial complex, and we see the rearmament story in Europe, we see the rearmament story in India too. Defence stocks, are they looking overextended in this environment?
I think defense stocks in India in particular have got a significant tailwind after the performance of the 5-day conflict between India and Pakistan, where a fair amount of indigenous technology was used to achieve a positive result for India. And the kind of conversations we have seen with the CEOs of defense companies, it's very promising. And it's, I would say, headlining that with a sad state of affairs as we see a lot of European companies in defense also perk up with sales across the board.
Indeed. Praveen, let's just pivot back to the consumer, because it's fascinating in the Indian context, isn't it? I'm sure you'll agree. The face of consumption is changing rapidly. E-commerce to quick commerce, financialization of the consumer, premiumization of the consumer. So talk to us about Trent, Eternal, formerly known as Zomato, of course, and Dixon Technologies, and why they are your preferred plays.
So India is going through this serious consumption boom. It's a movie we have all seen before. It played out in the US after the Second World War. In Europe, what was called as the golden phase of economic expansion, which was led by consumption boom. And India is experiencing that as we speak. It was started by giving every Indian a unique identity, the Aadhaar card, which connected with a bank account number, a unique address, and it enabled the government to use technology to segment Indian population for subsidies and direct benefit transfers. Now, that has really helped India's disposable income go up, and the way we see it play out is a greater consumption of discretionary items. So Trent plays to fast fashion. They have added about 160 stores in the last 6 months with improving results. Zomato, or Eternal as it's called now, what do people do when they become more affluent? They dress better, so clothes and shoes. They eat well, more protein, they try to go out more. So eating out, going to concerts, going for events, and ordering groceries at home, convenience, that really typifies the rising standard of living for middle-class India. And Trent and Zomato play to that completely. Dixon is a very interesting play. And you were talking earlier about how Lenovo and Apple are expanding their supply chains in India. And the one company that is at the top spot for creating the assembly lines to a standard which is global is Dixon. They started off with assembling electronic components for even the likes of Xiaomi, the Chinese phone maker, and they've expanded to making laptops and cameras and all kinds of electronic equipments. You would have watched this space as a call option on the India consumption boom.
Brilliant, Parveen. Thank you for that. And just allied to that, how do you feel about the banks against this environment of the financialization and banking the underbanked and the unbanked in India? Huge opportunities, huge addressable market potentially. Goldman upgraded the banks last month. How convicted are you towards this space?
I think banks directly speak to the consumption boom. Any consumption boom globally is predicated on availability of credit. And India is in a very early stage of this cycle. And quite interestingly, America is at a very mature phase of the same cycle where consumer delinquencies are reaching 30-year highs, whether it's auto loans or credit card defaults or even now mortgage increasingly. India, at the other extreme, very early, where household credit is a very small percentage of the GDP, and the desire to have a better quality of life, which means own a better motorcycle, own gadgetry like washing machines and microwave ovens. All of this is really coming through buy now, pay later. So consumer finance is a big move. And we expect the private sector banks of India, the likes of ICICI, HDFC, do really well in the coming few years. Not so much the state-owned banks, which are going to see rising non-performing assets.
Praveen, you took the words out of my mouth, and ICICI does appear to be the top consensus pick. But how closely are you watching what could be a turnaround story in the making at Yes Bank under partial SMBC ownership, possibly majority ownership in time?
It's a wait and watch. Yes Bank has been tainted, and it takes a while for people to forget the situation that arose for Yes Bank to kind of collapse. It's wait and watch. It will not be easy for them to make a big market share gain in a hurry. So we're watching it very closely. It is certainly very heartening to have SMBC take a stake in it. SMBC also has a stake in Kotak Bank, but Kotak has done well on its own steam and built its brand thanks to Uday Kotak's contribution over the years.
Praveen, we were talking to the chairman of SEBI earlier, and we were talking about the challenges associated with regulation or perhaps over-regulation of the SME IPOs. How are you participating in the small cap rally that we've been seeing recently?
Small cap, mid cap segment is very interesting in a certain stage of the economic cycle, or I should say the market cycle. And we have seen small caps do really well for the past few years, where the massive influx of money from the new Indian investors, the first time investors, close to 140 million of them, who joined the investing movement, if you will, after COVID. Micro caps, small caps were big with them. However, the performance of these smaller companies has been somewhat of a challenge, and one needs to be very careful with stock picking. So the market beta rallies, I think those times are over. Now is the time to pick alpha by being very careful in picking the right SME and at the right IPO. So mature end of the rally for SMEs and the IPO business.
Understood. Praveen, how are you approaching Pharma now that we know that President Trump plans to cut US drug prices? There's been a lot of flip-flopping, a lot of volatility, if you will, associated with the tariff picture and how it applies to pharmaceutical imports.
Yeah, I mean, US healthcare is extremely challenging, and any leader really has three choices when it comes to managing healthcare costs for the population. It's to deal with insurance costs, or the cost of hospitals and doctors, or the cost of drugs. The first two literally are not navigable by any administration: insurance prices and the cost of hospitals and doctors. So it really is the only lever that any president can pull, and that's drug prices. Now, India is the largest manufacturer of generics, which are exported to the US. 47% of drugs sold in the US are of Indian origin. It would be a tough challenge, and Indian Minister Piyush Goyal is in US right now negotiating the trade deal, and pharmaceuticals are, of course, center stage there. It would not be easy, and it would be a bargaining chip to get a deal through. But in the long term, greater volume for India's pharmaceutical exports augurs well for at least some of the pharma companies in India. So we're quite optimistic. So even if there is a slight price reduction, the volume will more than make up for it.
Understood. Praveen, let's get a bit more clarity on the trade picture, because many feel that Prime Minister Modi is closing in on what's been described as a triple crown event in terms of trade deals. UK-India already seems to be in the bag. EU-India, US-India are waiting in the wings. They're the grand prizes. They may take 2 to 4 years, we understand, to be fully realised and material. How then do you think markets ought to price this?
Sri, from what we have seen in the recent times, the market have this tremendous ability to see through any length of time. If they can see a long tunnel but light at the end of it, they're willing to wait and price in gradually. And the rise of India, if I can call it that, is closely linked with the globalization of India. Now, you'd notice that China, amongst the EM countries, was the first to globalize with its entry into the WTO in the early 2000s, and the rise of China is, of course, meteoric since then. India, through this entire period, was extremely happy to be focusing on domestic consumption, which is 60% of India's GDP. Exports is really a new thing for India, and India has been thrust into this happy place as the trade wars have escalated between US and China, and the world has sought a plan B, a China plus one. And India is rapidly gearing up to occupy this position of becoming more integrated with the global supply chains in very specific areas, and pharma is one of them, electronic components second, auto ancillaries, specialty chemicals, textiles. So there are a few specific areas where India wants to achieve a degree of global scale, and to that extent, as India integrates, it's great. It's fantastic for the developed world to keep its inflation down, because deglobalization as a trend is inflationary, which the likes of Europe and America cannot easily afford. They need a plan B to China. And I think India is stepping up smartly.
Praveen, let's close off this conversation by getting your take on the earnings story so far, and particularly the IT services numbers, which have been mixed.
Yeah, see, India's had a few good years of earnings. If you see post-COVID, the resurgence recovery in India was fairly rapid, and earnings hit high teens. And now's the time to digest that kind of growth, and earnings are now averaging at least about 8-9%, so high single digits, which is good. Consumption came off the boil in 2024, and it'll take a while for it to, get back into a growth mode again, which is greater than the nominal GDP of India. Globally, there is so much of noise and uncertainty that IT spends will be on the back burner for most major companies. They've got to understand what's happening with the tariffs, what's happening with the supply chains, and till such time, IT services companies in India will face a mixed, uncertain future. So I would imagine this is temporary, because global companies need to digitalize, and the digital transformation projects will continue with a slight pause until we get greater clarity around the tariffs and the trade wars.
Praveen, we'll leave it there, sir. Always great value speaking to you. Thank you very much indeed for those insights. Praveen Jagwani there from UTI International, joining us live from Dubai. Now, tensions still remain high between India and Pakistan. Indian Prime Minister Narendra Modi now saying that India has the right to use its share of water from the Indus rivers and that Pakistan will not get it.
Pakistan will not get water over which India has rights. Playing with the blood of Indians will come at a heavy price for Pakistan.
Pakistan, however, says that it maintains its part of the treaty and is willing to address any Indian concerns over it. That's, however, subject to both sides agreeing to talk. Bring it back to the markets, and Nifty 50, the benchmarks, have joined the trading day. We will look at some of the movers in Mumbai after the short break. Welcome back. We're about 10 minutes into the trading day in India. Let's give you the action on the benchmark Nifty 50, which is hovering above 24,700. We're up by just a fractional 0.4%. Dollar rupee exchange rate 85.9150. We're also watching shares of the steel makers as India's finished steel imports in April fell over 11% on a yearly basis due to a decline in shipments from China and Japan. Remember, India had imposed a 12% temporary tariff on some steel imports to curb a surge in cheap shipments, primarily from China. Bajaj auto stock also in focus after the company said that it plans to take control of troubled Austrian motorcycle manufacturer KTM as part of a 906 million debt package. That's it from us in this edition of Inside India. AME is up next.